Good day traders, Richard Jacobs here and welcome to episode 11 for 2018 on the Underdog Trade Education channel. I think I mentioned in my last recording that I wasn't planning on doing a recording this evening, but there have been a couple of interesting developments in terms of what's happening on the market and also some potential learnings that we can draw from what's happened on our forex trading side. So I thought this would be a great opportunity to share some of that with you. We haven't actually done any intraday trading today, and that's primarily because of what we spoke about in our last recording. Today was classified as a C day, and at the moment our C days have negative expectancy, so we're actually null trading them, we're not trading them, is another way to put it. And I wanted to share with you what would have happened had we traded them, and also share a bit with you what the differential between or what the difference is in terms of our expectation for the year to date, drawing this distinction between A, B and C days, because I think that's making quite interesting reading at the moment. And then obviously the other thing I wanted to highlight to you, we did have that breakout today out of that range that the market had been printed into. Higher high, higher close, we're pushing to the upside. So tomorrow we are going risk on again, and we're going to be maximizing our trade sizes as we look for the market to start expanding ranges again. The ATR is continuing to fall here, so we are now well below the 50 period moving average. So based on tomorrow's trading action, we're actually looking for some kind of a range expansion and looking to take advantage of that. We also in this 78.6 zone. Let me just zoom out quickly. So on this leg of the move down, we've retraced all the way back into that 78.6 retracement level. And as I've mentioned a few times, we're in the danger zone here between the 78.6 and the 100% level, where there is certainly the potential for the market to pop to the upside and break this previous structure high over here. Should that happen, obviously our downtrend to a certain extent will be broken, and we're going to have to wait and see what the market does then. But in any case, once we're having closed inside of this zone, we'd be a bit wary on this time frame, the daily time frame, of taking short positions in line with this trend continuation move to the downside over here. So just bear that in mind in terms of your trading. On an intraday basis, a couple of things we've seen here as well. Firstly, for those structured traders who had the patience, well done. We saw the market on, I think it was on Wednesday last week, pushed to the upside and then started its complex retracement. We highlighted this potential kill zone over here. Market pulled back into that zone, and then over the past 2 or 3 trading sessions, quite choppy, but it's actually meandered up, and you would have hit target levels here being this previous swing high. So certainly trending not in a straightforward manner by any means, but certainly trending to the upside over here. So now what's happened effectively from a structural perspective, we have what you would call a higher high over there. Let's just throw some of these lines in over here. So we've got that higher high, and we actually saw on an intraday basis the market did do a little bit of a retracement back to that breakout level, retesting that previous resistance, now support, and did a bit of a bounce over there. So certainly looking bullish. It hasn't really followed through on an intraday basis yet, but we'll certainly keep an eye on that and see if there's further potential for the upside. For now, short term is certainly bullish. Another thing to notice as well, and here I'll get into that discussion around those C days as well. After the initial gap up here this morning, the market actually printed itself into a very, very narrow range right there. I mean, that's probably about 200 points, so absolutely nothing to get excited about unless you'd actually managed to get in yesterday before the close, in which case you could have gotten the benefit of this gap up over here, but certainly nothing to get excited about on an intraday basis. So and that brings me to the point around these ABC days. Sorry, wrong one. There we go. So we had a couple of trade signals today which we put up in the WhatsApp group. I think, well, three in fact. One break even, two losses. And why is that something to get excited about? I mean, those trades would have lost about 153 points, and that's reflected in our standard equity curve over here. So at the moment, standard equity curve is at negative 123 points for the year to date. In other words, all those trade signals we've put out on the WhatsApp group have accumulated. If you account for slippage as well, it's actually a cumulative negative 123 points. Doesn't sound too great. If you'd sized your trades at the same level, you'd actually be in a loss-making position at the moment. But as you know, and I've been harping on over the year to date, we've been adopting a dynamic trade sizing strategy where we've been weighting our A days, standard sizing our B days, and actually null trading, in other words not trading on our C days. So effectively we never traded today, so we avoided these losses. And I suppose that's one of the learnings that's coming out of it. Avoiding losses is as important as making profits at the end of the day, because it's about taking the opportunities when they present themselves and the market conditions are favorable for you and maximizing those opportunities, and simply stepping aside, exercising patience, and avoiding the losses when they do occur. That's not to say that, you know, we'll not miss out of we will not, we might make profits on C days and miss out on those given the current conditions. Similarly, on A days doesn't mean that we don't lose on A days. We can, and we have lost on A days, but over time, it's been, in terms of our testing and what's happening in the year-to-date numbers as well, we've seen that over time the expectancy on these A days are much greater than the B days, and in turn the B days are greater than the C days. And that's really reflected in this weighted equity curve, which is where our actual trading is at the moment. We're sitting on 1,123 points on a weighted basis. Now, what I wanted to share with you, and again, it's early days. We're something like 38 trades into the year, including all of the trade setups. But what I wanted to share with you was what the results are looking like so far on these ABC days. So on our A days, let me just we've had, I don't have the data, give me 1 second. I'm just going to pull up the number of trades, break down the 38 trades for you. Okay, the beauty of the pause button. You guys didn't even miss me, but I was away for a minute or so just gathering that information. On our A days, we've had 15 trades, 8 winners. That's a 53% win rate. On our B days, we'd have 7 trades, 3 winners. That's a 43% win rate. On our C days, there have been 16 trades and only 3 winners, a 19% win rate. So simply by weighting our trading, and if you look at the average reward to risk, A is coming in at 1.66, B is at 1.57, C is at 1.13. So even in the reward to risk, there's been a benefit in trading those A days. So simply by weighting our A days more than our B days, and our B days more than our C days, in fact avoiding trading on our C days, because you'll see our C days for the month did have a negative expectancy, our B days have a small positive expectancy, and our A days have a much bigger positive expectancy. So simply by weighting our trades on those days avoiding trading on those C days, that's what's allowed us to achieve this equity curve that we generated in the month to date. So I wanted to share that with you because yes, it's a limited sample, but it is becoming quite pronounced in the year-to-date numbers. And they certainly over time, what we've also seen is that we're only 23 days into January, but certainly over the months and the years that we've backtested and also traded this in a live environment for a period of time, we've certainly seen that this relationship holds true. The dynamic between A, B, and C days varies in the sense of the extent of the weighting, but it holds true over extended periods of time that A days are better to trade than B days, and B better to trade than C days. So I wanted to highlight that, and then also just point at the fact that tomorrow we are going into an A day, And just to stress, doesn't mean we are going to only have winners tomorrow. I mean, at the end of the day, we only have a 53% win rate on A days, but certainly our expectancy is what we're banking on here. So we continue to weight our trades bigger on these A days because we have a better expectancy based on our historical results on those days. So that's what I wanted to point out to you guys there. Let's have a look at what's happening on the international market side quickly. Let's load up the pure price. So this is the S&P. S&P continues to kick to the upside, putting in these higher highs in a quite a structured manner. Sorry. Now, do we have an expectation of where this market will go? Well, you could have asked me that at any particular point of the year, and it would have been difficult to call. I suppose let's have a look at some Fibonacci, see if there's anything there that can give us a clue as to where this market might find its next point of resistance. On this last leg, we saw a push up into the 141.4 before we saw a retracement. At the moment, we're sitting on a, this is the Fibonacci projection that I'm doing. Of this leg of the move, we now see the markets pushed into that 141.4. The 161.8 is coming in around about that 28.50 level, or slightly above the 28.50 level. That might be, just in terms of the round number, 28.50, 161.8. There's some confluence over there. Maybe we see some resistance over there. It's difficult to tell at this point. We're flying in open air. We can't look left and see where the market has been, because it's never been at these levels to date. So certainly still remains bullish, and one of those situations we don't really want to try and call a top as yet. If I look over at the Hang Seng, it's the other one we've started looking at, still just continuing to push to the upside. Nothing exciting happening there. The DAX, Germany, pushing to the upside again. Also very difficult to call where this market's going to be going. It's not even showing a retracement as yet. And finally the FTSE, that was the one we'd highlighted as potentially looking vulnerable. Chopped along sideways for most of the day, or since our last recording. We highlighted this potential head and shoulders over here, but we haven't really seen a break of the neckline yet. If we do, then that might change the dynamic in terms of the DAX, but certainly for now it looks like it's in a bit of short-term consolidation. Sorry, not the DAX, the FTSE. If we look at the exchange rate to see what the impact has been over there, again, bit of a choppy day. Call it a bit of, we've got a bit of retracement over here that's played out. So the market had broken out of that zone, put in the lower low, put in a bit of a retracement back into that previous structure, support now resistance. Sorry, I really got a irritating little cough here. Then it pushed to the downside, did a bit of a bounce here. It's almost or just about closed that gap, that post weekend gap over there. So, and then it's pushing to the downside, so still certainly in a strengthening trend. And just to bring that back to where we are at the moment, strengthening top 40 generally, strengthening rand generally points to a top 40 rolling over to the downside. But we've got, as you have seen, all that positive momentum pushing on the international market side, which is really holding this market up. So as I said, be wary about just taking shorts at these levels on this higher time frame to try and ride it to the downside. So that's what we have in terms of the top 40. I mentioned there's a couple of things that I want to highlight on the forex side on our trading challenge. So let me pull up those charts. Okay, so that's where we're sitting at the moment. We had 4 positions closing out since our last recording, which I'll speak to, and that's, I think, to a certain extent where the learnings are coming from. And then we've got 4 open positions that I'll just run through quickly. Firstly, if you look at the results, they're fairly modest losses and very modest gains. In fact, I think I dealt with that Euro Swiss franc closeout over there. But one of the things that I've seen, or we've seen, is that we are being a bit too aggressive potentially on our stop rolls. And so what's happening is as soon as the market moves in our favor, we're rolling the stops quickly. And to a certain extent, yes, we are de-risking the trades and reducing the amount of potential losses, but we're not giving these trades enough breathing room, is what I'm thinking at the moment. We've been using as soon as the market moves in our direction, we've been using a 3-bar trailing stop. And what's happening is as soon as you have short-term consolidation, you get stopped out on these things. So for example, on let's have a look at the USD Japan first. That was a short position, so here's a great example. Market had pushed down, retraced. We saw a potential for continuation move. We got short, market pushed down. We rolled our stops down, and look what happened. Market pushed up, stopped us out, and then it rolled over and almost hit the initial target level over there. So clearly we didn't give this trade enough space. A better strategy, and one that we're looking at employing, is rather using structure rolls. So if you want to get the reward, take the risk. So get short here, and only when you put in this lower high over here, then roll the stop to above that high and let the trade run its course. I think there's a couple of other examples here. What's the other one that we closed out on? Oh, the gold trade. So the gold trade, that was quite unfortunate, I think, because it was looking pretty good. We closed that for a modest profit, and look what's happening over here. Again, market had pushed to the upside. Oops, sorry, let me just bring that back. Market had pushed to the upside, put in a complex retracement. We managed to get long over here, looking to ride it up to that previous swing high over there. Pushed up, we rolled stops, we got flushed out, and now it's continuing to the upside towards our target. So again, giving that trade more space and only rolling the stop once we put in that higher low over there. That would have been a better option to use. The Euro Swiss franc, let's have a look at that one. So guys, I mean, the reason I'm sharing this with you, because this is in my view, this is an education channel, so we learn from each other's mistakes as well. You can learn from the mistakes I've made, or I make. As I said, this is my personal trading channel, my personal trading account, so I'm quite happy to make these mistakes over here and to share with you how we learn, how do we develop, how we refine our trading as well. Euro Swiss franc, market had pushed to the upside, put in this deep retracement. We got long on this one, or our last long position was on this one. Market pushed to the upside, we rolled our stops, and look, we got flushed out again. It's not to say this market will push up and hit target, but really I think the learning is that you got to give the trade space. Try and you're aiming for the reward, and the decent rewards that you're looking for, take the risk. Your risk management at the inception of the trade is what restricts your loss or your total exposure, but you must be willing to put that on the line if you want to achieve ultimate reward. So if this pushes up to the upside, I wouldn't be surprised, and again, it would cement the fact that a better strategy would be just to give these trades more space. I think the other one that closed out was Aussie US dollar. This one's probably a more legitimate one, although we did do a bit of stop roll here, not much. Aussie US dollar had pushed to the upside, retraced, we got long over there as it pulled back into the 38.2, nearly touching the 61.8 retracement level, pushed to the upside and then rolled back down to the downside. But what this has done now is put in a complex retracement. So we still got that push to the upside, we put in the higher high, then we retraced, complex retracement. We're still within this overall structure level here, which is what we regarding as our structure, and after that bullish candle we've actually gotten long again. So this time we are long, we've put our stops below the swing low, and we're going to give this thing the space to try and push up towards those target areas over there. So that's one of the open positions we have as well. Other open positions, the USD CAD, let's have a look at that one quickly. I think that's a long position as well. Yep. It's a long position, not my favorite long position, I must admit, and I'll talk you through that logic as well. What we had here was the market had come down, putting in a series of lower lows and lower highs. Then we saw this break up here, or this retracement turned into a break of structure to the upside. The reason I'm not too excited about this is one could argue that the initial break of structure to the upside really doesn't give you a trend yet. You'd want to actually see the initial break followed by something like a retracement and then a higher high to give you the trend, and then you start trading this thing. We sort of took it off the bat, and the reason it's that's perhaps not the greatest trade in the world is that you could have a false breakout over here. In other words, this market's pushed up, it's got a false breakout and is looking to roll to the downside. So this might be one that we potentially close out prematurely, but let's give it a bit more room and see what happens. It's not doing too great at the moment. It's about 10-11 pounds down. Won't break the bank by any means, but certainly not one I'm too happy about having taken. What is the other open position over here? Let's just pull up that chart again. We've got USD CAD, USD Swiss franc. Here's one that we got short on. Market had pushed down, put in a lower close. See, we got a nice trend going over here. Retrace back up into structure into the 61.8. We got short off following this candle. Market chopped along sideways, it pushed down nicely now in a leg to the downside. So we're just looking for this market to continue and just tap in on target level. So that one's not looking too bad. I think we've done pretty much it. Yeah, I mean, this was the other one. This is the Euro Japan one. Again, market had pushed down, retrace, put in a bit of a complex retracement. Actually closed inside of the 78.6, but then it closed outside of the 78.6, so over here with a bearish candle. We got short, stops up there. Market initially pushed down, put in a retracement, didn't stop us out and pushed down again. So we're going to keep an eye on this one. Looks quite choppy, but hopefully we can just continue or put in some kind of continuation with the downside. Again, this is one of those we're going to exercise patience as we put in the structure. Lower highs, we'll roll our stops, but I don't want to be too premature in terms of doing that. So guys, that's pretty much it from our side. Thought I'd share some of those things with you. It's always nice to be able to share something on days where you're not really doing much trading, but you are learning at the end of the day, because that's a large part of what this is all about. It's about developing, it's about learning. You don't have to be active in the markets all the time in terms of trading, but as long as you taking something from what the market is doing, if you add a little bit to your trading arsenal every day, something to think about, something to potentially add to your own testing, that's going to add to you as a trader and help you to develop. So that's all for now, folks. There is a good possibility, I'll say this again, that I won't do a recording tomorrow night, but if I do, it will probably be something I'll just fire off quickly. If I don't, and I wish you all the best over the next couple of trading sessions. Be safe in terms of your trading and exercise good risk management. I'll chat to you soon. Cheers.